I'm Chris Preston.
I'm Brad Simmerman.
Welcome to Street Check, the best two-person podcast in the history of Cabot Wealth Network, which has been delivering investment advice for more than 50 years. Brad, it's pay the piper week for me. We made a bet on last Friday's episode at the top. Our two Wobegon NFL teams, your Arizona Cardinals, my Buffalo Bills played. And it was predictably a kiss your sister result, at least in regards to the betting line. Bills were favored by 6.5. They won by 6.
Yeah.
So you're not too happy because the Cardinals lost. And I'm not happy because I have to eat some hot sauce, as we tend to do on this podcast when one of us gets something wrong.
Yeah, kiss your sister is a good way to put it, I guess. But I think I'm more in the win camp because the Cardinals are bad.
Well, you won the bet. Yeah.
Yeah, I won the bet, but they lost the game. But that they had like the worst secondary. Their secondary play in that game was about as bad as I've ever seen from a Cardinals team. Despite Budda Baker being really good and being back there, they just could not get a stop. It took a miracle punt return for a touchdown to keep them, just to get them to cover the spread. And you guys are 2-0 after last night.
Yeah,
So
we won handily last night. Wish you were a Dolphins fan. That would have been a easier bet to make, apparently. Okay, so I think our agreement was for the 10 out of 10 hot sauce, which I still have handy, the Apollo Last Dab.
How much of that bottle have you gone through so far?
Half. About half.
This is what we do for you listeners and viewers. Chris has gone through half a bottle of the hottest hot sauce we could find.
It's maybe it's like 45%, but it'll be half after this. I'm gonna give a big chunk. I'm just doing, I think one chip was the agreement, but I'll really load it up. So
do you have a beverage before you get started?
After.
Okay.
Yeah.
All right. So I'm going to fill some time. Chris, if you're listening, seems to be enjoying it. Now he's shaking his head, remembering what it's like to go through this.
Oh my God. It's been a while. Yeah. It's, yeah. I did put a lot on there.
Oh, so you know what we're going to do? I'm going to mix this up a little bit. We will go through our rundown right after Chris does Defend the Take. We're going to go right into Defend the Take for a minute and a half of Chris nonstop. Chris, this week
it's good podcasting. I respect it.
You're up for Defend the Take. Your take: small caps will hit all-time highs by the end of the year. You have 90 seconds. You may begin.
Okay. Yeah, that is my take. So that would require a 15. Well, they're up to, the Russell is up more than 2% today. So it'd be more like a 13% move through the end of the year. But I feel confident in it. Why do I think this? Because small caps tend to outperform large caps, as we've heard from Tyler London, our small cap expert, on here many times. Small caps have been underperforming for 5 years. Historically, they outperform large caps 3 out of every 5 years. Well, it's been 0 out of the last 5 years. You know, this is just not purely. On the surface, it's sort of just a law of averages. Small caps are due kind of a thing, but they also have momentum. You know, if you recall, earlier this summer, they had sort of a fake out. Middle of July, Russell went up from 2029 to as high as 2263, then fell all the way back down when the market bottomed in early August. But now it's has momentum again. But one thing Tyler said that really stood out to me is that small caps will benefit more when the Fed starts cutting rates. And the Fed is going to start cutting rates almost certainly next week. You know, we're going to get into rate cut talk more later, but I do think that the reality of rate cuts will be more of a catalyst than the rumors of rate cuts. And that's why I think that'll be a big catalyst for small caps. It's a bold claim, 13, sorry.
All right, Mercy.
13% from here, all-time high, or sorry. Yeah, new highs from here. Is that what I said? Yeah, hit new all-time highs from here. But they're due, and I think they're going to lead the charge, especially if not right after rate cuts, then after the election.
All right, bold take. I'm going to give Chris.
I think I made it through that pretty well, considering how much pain I'm in right now.
Yeah, it was a little bit quicker than normal. You were struggling. I could see you like the amount of effort to get the words out, but you did good. You done good. All right, so I'm going to give Chris a second to catch his breath, and I'll give you the rundown. Chris has done his defend the take. For the rest of our segment of the episode, we are going to talk about the latest inflation print. And obviously, we've got the looming Fed cuts at the end of or middle of next week. We're going to talk about a few low risk options for cash on the sidelines. If rates are coming down and you're in a high yield savings account, you've got to replace yields somewhere. And then we are going to talk about cannabis stocks rallying on the heels of some positive commentary from presidential candidate Trump. So it seems like the politicians are sort of all on the side of cannabis investors right now. And then after that, we're going to welcome on Clif Droke of Cabot Turnaround Letter and gold and silver investing expert. We're going to have a conversation with him about the promises of some turnaround sectors, what he sees with gold, et cetera, et cetera.
Water really doesn't help at all, does it?
No.
I think it's like I think it's making it worse. Um, okay, my turn. So yeah, number one in our big three. The last inflation numbers almost certainly before the Fed starts cutting rates came out this week. Both CPI and PPI came in lower than they've been in multiple years. Is this the last time we'll care about that number in whoever years? Hopefully, I mean, we talk about this, at least once a month on this podcast since it launched. Is this the last time we'll have to talk about at least inflation numbers on this podcast for a long time?
No.
No.
No. Here's the thing. Here was my takeaway from I have a bigger stance on the Fed process, but here was the most important takeaway for me from the latest inflation numbers. Headline CPI was dragged down significantly by declining energy prices. So we've had, and I think you were right saying it's premature to be bullish on energy last week. I think I'll pay for that one later. But energy prices dropping pulled it was something like 0.8% month over month decline. That helped pull CPI down. If we are still focused on headline risk, and if the Fed comes out and cuts slowly, as we've been talking about, and as I fully expect, the next sort of talking point will be, is inflation just going down because economic growth is slowing? If that becomes the narrative, or if that becomes a common talking point, there will be a lot of attention paid to core CPI reflecting a weaker economy than what the headline number seems to be saying. Because if energy prices are down 0.8%, that's because of economic weakness specifically. That starts raising the specter of stagflation. So unfortunately, I mean, this might be the last time we talk about like the Fed rate policy and what their pathway looks like, but I don't think it's the last time we talk about inflation.
And that's the key. I don't think anything that happened this week or that will happen in future months will really impact or change the fact that the Fed is going to start cutting rates probably pretty consistently. I think you and I have fallen on the side. We might as well make one last prediction since it's happening next week. Or fallen on the side of the Fed will only cut twice, 25 basis points each, so 50 basis points total between now and the end of the year. A lot of people are now thinking it'll be way more than that, up to 100 basis point. I'll let you vamp while I pull up the latest Fed watch odds.
Yeah, while you pull that up, actually Fitch, the ratings agency, came out with their call a couple of days ago, and they are parroting our talking points. They're saying the Fed's going to cut 25 is going to cut 25 basis points now, and then another 25 in September. That's
like in November.
No,
or
in
December.
So Fitch is saying 50 basis points total before the cuts in total before the end of the year, one in September, one in December. That was my pitch. That's where I stand still.
Here's where economists stand. It's up to 43% believe that the Fed will cut 50 basis points next week. Still 57% think just 25 basis points. So I guess we're going with the majority there. But then it's up to 24%, nearly a quarter, think it's going to be 75 basis points by November. and more than half think it'll be 50 basis points by then. So in total, 3 out of every 4 economists think that the Fed will cut rates by at least 50 basis points by November. You and I both think that they will not do anything in November because of how close it is to the election. We could be wrong. I think we both think 25 each, September, December, and I don't think that would be a reason for panic. I mean, maybe the market will disagree, but I don't know.
The,
I think just seeing rates cut and cut, especially cut more than once, will be enough to, satisfy the masses.
yeah, the Fed is still an agency that is to some degree beholden to public opinion, because it directly influences the market. I think you will see a more negative reaction if the Fed comes out and cuts 50 basis points in next week, and then if they were to come out and make another 50 basis point cut in November. It's too close to the election. They're going to get flack for seeming political if they make any big moves. I think 50 basis points would probably end up spooking the market a little bit, because then it becomes, oh well, what are we missing that you feel the need to cut? If the narrative is still the economy's strong, unemployment's is back where it should be, job growth has slowed down a little bit, then you don't need to cut 50 basis
Yeah,
points.
it would be a tacit admission that like I think we were a little late to the party here, and
Yeah.
we actually are kind of worried, and so we need to start really flooring the gas on cutting rates.
Yeah.
I
And
do
with
think,
it,
yeah,
yeah.
100 basis points between now and the end of the year. I think that wouldn't be a great look. I think that would be
Yeah.
like we messed up.
And especially lead it right into the election. That 25 is nice and safe. They can avoid sounding political. They can deliver cuts as advertised. They can avoid spooking the market, right? Like you want the market sort of near all-time highs going into the election, and then you don't seem biased at all.
Yeah,
That's I don't know. That's where I am. It would take a lot to convince me otherwise.
yeah,
I mean, maybe like if we get a string of really bad inflation reports or job numbers or really bad news in November, or in October, November, we get some October surprise. Maybe there's a change in path, but I'm pretty locked in on the September December cuts and 50 basis points total.
yeah. Totally agree. Okay, that leads right into our second big three topic. With rates coming down, we want to discuss some lower risk options for cash, bonds, dividend stocks. I mean, we've talked a lot about how uh, there's already so many people in cash now. By the record amount of cash in money market funds, $6.3 trillion on the sidelines. So, that's you talked about the utility trade, worried about being the utility trade being overcrowded. That, I guess cash can never be too overcrowded,
Yeah.
but feels like it is. Which low risk option do you sort of fancy right now?
So we just talked about what the Fed sort of path looks like. I am firmly of the opinion that the Fed cutting cycle is going to be much slower than people are expecting, and that the terminal rates for like where they stop cutting are probably in the high threes or low fours in the next calendar year or so.
Yep.
At those levels, I'm not getting fully out of cash. If the Fed comes out and cuts 25 basis points and I can get 4.75% on like a high yield savings or something like that, that's still a really attractive yield. We talked last week about utilities paying about 3%, but in exchange for that, you're taking market risk, and that's pricing in a lot of government spending as well because of the Inflation Reduction Act and the green tech legislation and policies and stuff like that. So taking on market risk for an extra 175 basis points isn't super appealing if I can still get high fours on cash.
Yeah.
So I am leaning more into the maintain a cash balance for as long as the Fed is cutting really slowly. After that, you know, CDs it really depends on what your cash is for. Like if it's maybe that's the distinction to draw, right? Like they say you should have 6 months of savings on the sideline in case you have an emergency or job loss or anything like that. For that pool of money, it doesn't matter what return you're getting because what it is that it's an emergency backstop for you. If you've got cash on the sidelines that you're saving for something, look for stuff that has a expiration date or that has a maturity date that's close to when you know you'll need the cash. That's stuff like, hey, I need to buy a new car next year. I've got 20 grand saved up. Hey, look at, a CD with a fixed term, something like that's perfect. Or I have a wedding in January of 2026. Fixed term CD is great. Short term treasuries are solid options there. Um, if you're looking to juice your yields a little bit more, treasuries, I think, have a lot more upside still because we are entering the rate cutting cycle. Buying a treasury fund where they're still depressed. I mean, you look at something like, I'll say TLT because it's right around $100 a share. It's the 20 plus year treasury fund. That was trading around 130. Uh, the last time rates were near zero, there's still upside there, but you are taking interest rate risk. So if you are sitting on a big pile of cash, first thing is to assess what you need it for and when, and then you can explore options. I do think you've got room with utilities. I do think you've got room with treasuries and bond funds. But if it's for now, cash is still kind of king, unless the Fed totally flips that theory on its head, which they could totally
Yeah,
do if
I
they
think it depends on your timetable. In the next year, I agree with you that like you know uh, cash CD treasury is a good way to go. Rates are still high. That's not going to. It'll change in the next year, but it's not. I agree that I don't know that it'll dip much below 4%. Um,
But it is
but if you're
important.
looking out, if you're looking out further than that, beyond a year, dividend stocks are historically a good place to be. We've run every few months. We run Tom Hutchinson's piece about which he's presented at the Cabot conference in the past. Like 5 of the most obvious dividend stocks and how they performed over the course of 10 years with dividends reinvested. Not all of them beat the market. I think 4 of the 5 did, but every single one of them, like tripled or at least, were up
Yeah.
150% or something like that. Um, you know, and what were the names in there? Like it's like Pepsi
Guys
and
like Pepsi, Home Depot, like these big, not like undiscovered stocks that nobody's ever heard of, like
right,
big multinational corporations. Buffett famously makes more on the dividend from Coke than he spent to actually buy the Coke position
right.
back in like the 70s. But I do want to hit the time horizon thing because I'm talking about having cash on the sidelines. Well, my kids are going to start going to college in 3 years.
Yeah.
So I don't have a ton of flexibility to
Yeah.
take market risk with that.
Different for everyone. Yeah.
Exactly. If you're looking at a 10-year time horizon, you want the equity risk because even if inflation is right around 2.5%, 2.4%, that's half of your yield if you're just sitting in cash. So you can't do that with a 10-year time horizon. But
Yep.
if you're looking out a year, 2 years, 3 years, that's where I'm more advocating for cash or for bonds.
Right. I think we're talking as kids, as parents of kids who are at different ages. Yeah, you said,
Yeah.
wow, you're three years away from college. That's wild.
Yeah.
Mine are 8 and 10 years away, respectively. So dividend stocks are perfect for that. But yeah, I mean, I think sort of all of the above approach to what we've said. I think safest, especially in the near term, cash CDs, treasuries, but having a portion of your portfolio in dividend stocks is always a good idea. I think.
Yeah, if you're still working, like you don't want your 401k in cash because what'll happen is if you're 45 and you look back at your 401k balance in 20 years and you've been 10% in cash, it's just going to be dead weight in the portfolio.
Yeah. Yeah.
That's where you want growth stuff. That's where you want dividend stuff, where the power of compounding can really help over time. Um,
Yeah.
so it's very individually specific, and time horizon is really, really the big factor there.
Just a quick update. The pain has transitioned from my mouth to my heart. It's when it's reached the heartburn stage, which is probably better for podcasting at least, but maybe not for my health. Okay, let's get to the final item in our big three. Did Donald Trump just save cannabis stocks? That's an extreme way of putting this, but Trump did come out and say that I think you have the specifics on this a little bit more. That essentially that he supports um, rescheduling of cannabis stocks from class 1 to a class 3 drug, which has been pushed back to December, which was a big, a bummer for cannabis investors. Cannabis stocks fell because a lot of people thought that rescheduling was the next big catalyst that was going to happen before the election. Um, and so rather than hinge, also he said that he supports it's on the ballot in Florida. Legalization is on the ballot in Florida, his home state, home state of Florida. He supports that too. That's another big catalyst that's on the ballot in November. So now instead of it being totally dependent on one candidate winning for cannabis stocks to possibly get a bump in November for Kamala Harris, Tim Walz winning. Now, as Michael Brush, who's our chief analyst of our Cabot Cannabis Investor Advisory, now it's you get a bump either way, assuming Trump is means what he says, I guess. And so we saw a bump from cannabis stocks since he said that. What was it, earlier this week or end of last week? Regardless, the MJ this is Amplify Alternative Harvest ETF. MJ, it's sort of a proxy ETF for cannabis stocks, up from 311, which was a 2024 low or matched a 2024 low, up to $3.30. Not a huge bump, but up off the bottom. What's your take?
Yeah, it's tough. So the big take is that everybody seems to be rowing in the same direction
Yeah.
politically. My understanding is that Trump on Truth Social said he was voting in favor of the Florida legalization initiative, or
Yeah.
the Florida initiative to allow for recreational use marijuana, which then you sort of have to extrapolate out and say, okay, well, if he's in support of it for this particular state in this particular instance, then that's going to present less likelihood that Republicans as a whole will oppose other reform measures that are coming into play. But it's unfortunately, it's not as if there's a clear cut plan about exactly how we would prioritize safe banking or rescheduling or any of those sort of disparate elements that are in place right now. The big thing is that everybody is sort of on the side of cannabis investors, assuming that Trump does vote in support of the Florida referendum, and that is representative of his policy stances going forward. I'm hesitant to take too much away from that because it is it's election season. People have a tendency to come out and say that they are prioritizing certain policies or taking certain stances that then go on the back burner because they're not huge priorities, but they are maybe beneficial from a vote total standpoint.
Yeah.
So I'm hesitant to read too much into like this is a green light that we're getting widespread rescheduling and it's going to be federally decriminalized or any of that. But
Yeah.
it does sort of change the context a little bit because Kamala Harris and Tim Walz are more supportive of cannabis reform. Walz, from his time as governor, signed some reform bills. Harris, I mean, other than her time as a prosecutor, where she was coming down hard on drug dealers, she has shown some interest in reform and podcast appearances and stuff like that. So everybody seems to be on the same page with like, yeah, things are broken. We can probably be more permissive with cannabis use. So it's a much better environment, but there still are not a ton of catalysts in the immediate future.
Yeah.
Uh,
I think cannabis stocks have they've been down for so long, 3.5 years now. They're the rare buy the news and rather than buy the rumor, sell the news, buy the news. Wait for the
yeah.
news, like, and I think that's what people are doing. Yeah, people will buy the rumor, cannabis stocks were up some after Trump said that earlier this week, but then they tend to just retreat back down to where they were before or close to it, waiting for the actual thing to happen. Rescheduling been talked about for a long time now. It hasn't happened yet. Safe banking um, policy or a bill in Congress which would allow banking access to cannabis companies. Talked about for a long time, hasn't happened. Florida legalization on the ballot in November. Trump says he supports it, but we'll see if that matters. I think cannabis has earned the. I still think Michael Brush. I don't want to downplay investing in cannabis investor, because I do think those catalysts are coming, and I think you'll be happy investing in cannabis eventually. But it's earned the distinction of prove it, or not distinction.
Yeah.
They need to prove it after this many years of just being beaten down and this many false starts and this many sort of supposed catalysts that have yet to come to fruition.
Yeah, for me, safe banking seems like the biggest potential upside
Yeah,
catalyst because that lets them start
maybe the
writing
furthest
all.
out.
But it also changes the fundamentals of the companies because they can start taking tax write-offs. Cannabis companies, if you deal in Schedule One drugs, you cannot deduct operating expenses from when you're calculating profits. So your uh, so your tax liability ends up being really, really high.
Yeah,
There's been pushback from cannabis companies where they're saying, well, we're just not going to comply with that. And there's lawsuits around it. That's the big one. And it also opens up Wall Street a little bit. If you've got safe banking going through, that's when institutional investors can start feasibly. A lot of these safe banking bills have allowed for institutional investment because that's what really moves the market on shares is big money coming in and buying them up. Retail investors just don't have really the juice to do that, with a few notable exceptions. Especially in the earlier this year and back in like 2021. For the most part, it takes institutional money to move stocks. And I think that's part of why cannabis has been like, hey, what are you waiting for so long? Is there's just not enough money behind it. There's not enough money chasing the moves. There's not enough money pushing up the prices. Um, Private equity, right? Like any kind of organizational buyout, anything like that is pretty much off the table for a lot of investors for the same reason, because who are you going to then sell to, right? A pension fund can't buy it. Big institutional buyers can't buy it. So I think there's been a lot of talk and just not a lot of money moving around in the background, which makes it hard to really get a ton of traction in cannabis names. And retail investors have been, as you said, they've been burned. They're all cautious. So who is throwing money at it becomes the important question. So I do think if we get federal level decriminalization, that fixes it without safe banking. If we don't get that, safe banking fixes the economics of it a lot better than this sort of state by state rollout that we've had, because you really need big money flowing into the space to get meaningful moves. It's still a prove it story, but like you said, it's also fortunately a buy the news kind of story where these names aren't moving a ton in anticipation of the news coming quite so much as, hey, the news is here and we're just sort of waiting on this deadline or that deadline.
right. Yeah, until one of those deadlines, or no, the news isn't cannabis rescheduling is coming. Rescheduling is the news now
Yeah.
that it'll take to actually move cannabis stocks, I think, at least in a more sustainable way. Okay, let's get to our guest for this week, Clif Droke, in just a second. Okay, we welcome on Clif Droke, who has been on the podcast before in sort of a different role. Clif is a gold and metals expert and has worked for our Cabot Top 10 trader advisory as a contributor, and has also been a writer for Cabot Wealth Daily. He now has taken over as chief analyst of Cabot Turnaround Letter. So we figured it'd be a good time to have you, Clif, on in sort of your different role. You started out as a turnaround, or maybe not started out, but you have a long history as a turnaround investor. Is that right?
I have some history as I guess my primary focus in gold as a gold and metals analyst has been more momentum driven. But
Right.
I wrote a book on turnaround trading back in 2005.
Oh wow.
I did have experience with it. Um, I'm getting back into the swing of it, and frankly, I'm enjoying it. It's there's a lot of opportunity in turnarounds right now after the correction we just went through.
Yeah, and I was gonna say, like, I mean, even before the sort of recent mini correction, it hasn't been. We've talked a lot about this. Has not been a traditional bull market where rising tide lifts all boats. It's rising tide lifts the Magnificent Seven boats and weight loss drugs and some AI stuff. But so I imagine there's a lot of opportunity out there now and even a month ago for
There's a
turnaround.
Oh,
Yeah,
absolutely,
yeah,
in multiple sectors, even in industry groups, and in fact, just about every industry group has a series. I'm going through the charts every day of all the sectors, and it's just like you're writing down one after another. The
right.
potential is there. The fundamentals are there. Uh, yeah, it's a great time to be a turnaround investor.
Is there a
Now,
sector or sectors that really sort of jump out right now?
Anything interest rate sensitive is jumping out. I'm seeing particular strength in if I had to pick, I think everyone knows this, the strongest, in my opinion, the strongest sector is utilities. And there are some turnarounds there, but it's more of a momentum play, of course. Of course, consumer staples, um, software is also, people don't realize that it can be, it's considered somewhat interest rate sensitive, and it's starting to outperform. The lots of turnaround plays there. Of course, gold and silver. Um, yeah, those are the ones I'm mainly focused on right now, and healthcare in general.
what do you look for mostly with software? Like utilities, Chris and I talked about last week. It's best performing sector this year. And it's a clear like one to one for me to get to how you can get to where the direct benefit is, other than just the cost savings from interest rates and easier capitalization with dropping interest rates. Is there something else that you look for with software names to signal that they might be good turnaround candidates?
Well, just the fact that many of them sold off very heavily in the last correction, and some of them have been down for a couple of years. The software the software investment cycle has been down, and it's starting to pick up again. More firms are beginning to invest in software, and that's, I think it's turning up the industry in general. And the momentum is starting to build there across a lot of these individual companies. And I just look for the ones that have the most value, and they're starting to perk up. So there's yeah, the opportunity is there for sure.
Are you looking mostly at mid or smaller cap, or are you looking primarily at some of the larger cap names?
I think most of the I hate to say destruction, but most of the damage was done to the smaller cap names. Uh, the ones I'm looking at are mainly mid cap, but there are some small cap names. Um, the like I'll throw a name out. MongoDB, symbol MDB, is starting to perk up. That's one that I'm looking at, and that's it. I think if you take a look at that, that's sort of, it gives you an overview, sort of a microcosm of what is happening across the broader industry group for the beaten down names.
Yeah, I remember MongoDB from the 2021 run. I think my timing is right on that. That's one of those former leaders that, Mike likes to talk about periodically when he's looking at growth potential.
Exactly. Leaders that have fallen out of favor and they're slowly coming back into favor, but they haven't garnered mainstream attention yet. They're still under the radar, and that's really the draw, the benefit of the turnaround approach. You don't want where people are just piling into it. Uh, you want to get in there before it gets into the mainstream.
Right. Yeah, I was going to ask about just your general turnaround investing philosophy. I mean, do you look a lot at, former leaders that have fallen on hard times, but, the growth hasn't necessarily changed, at least in terms of, revenue, earnings growth, that kind of thing? Or is it sort of run the gamut of all or different shapes and sizes in what you look for in a turnaround?
Well, it can run the gamut, as you say. I don't have a specific criteria that, like one, two, three, four, five, six. It's got to meet all these individual criterion. But I do like to see, of course, that the revenue growth potential is there, and obviously you want to see value, but what I'm looking at from strictly a technical perspective, and that's something that I think is missing in the turnaround process. A lot of turnaround specialists focus primarily on fundamentals. One of the first things I look at, frankly, is I look at the charts and I just want to see, has this stock established at minimum a 3 to 4 month bottom, to where you're not catching the falling dagger. It's not consistently making 52-week lows. The selling volume is clearly drying up. You're starting to see some institutional interest reading between the lines, or in some cases, if the institutions will come out and tell you they're interested in this stock. And I want to see the early stages, of an upward trend. So I think the technical base has to be there before you can seriously consider a turnaround, in order to minimize, downside potential.
Yeah, that's we have talked probably not a ton on this podcast, but a little bit about how badly value stocks have underperformed categorically. Where it's like, hey, fundamentally, these companies are sound, these companies are strong, but unless you have that technical momentum, what you look at is, I mean, for value stocks, it's been a lost decade, essentially. Like for the last 10 years, they've drastically underperformed. So I really do like that momentum, that prioritizing momentum approach that you're taking. Because without it, it's like, yeah, it's a great value, but nobody wants it. Like that's what you're contending with.
Exactly. One of the first things I was taught when I got into the business, back in the '90s, and I know this is elementary, but sometimes we forget it. With real estate, it's all about location, location, location. With the stock market, it's liquidity, 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 and really, at the end of the day, short term anyway. The only thing, short to intermediate term, the only thing the market cares about is there enough liquidity, and that can only primarily be discerned by looking at the chart, and that tells you that there is some informed buying taking place. And without that, it doesn't matter how good the fundamentals are. You've got to see that technical support has to be there, or else you could just be wasting your time.
I think right now there is sort of a perfect fusion, just from reading your issue today, not to step on it too much, but there's sort of a perfect fusion of two of your biggest interests, turnarounds and golden metals. I noticed you had a couple new gold stocks in there, or golden metal stocks in there. I won't give them away. With gold prices I think they're just hit new all-time highs above 2,600 an ounce. You'd think, that maybe they'd be a bit stretched, but it sounds like, you like them as a turnaround play right now.
I do. Again, just looking strictly from the technical perspective, if you look at the gold chart, it's not stretched. It's been consolidating for the last few months. So it's not like, for instance, utilities, which are just, going straight up. It's got some, what I view as, it's balanced. The market is balanced, and there doesn't seem to be a lot of interest from smaller retail traders. So it's not a case of, the so-called dumb money is rushing in, which often indicates a top. I don't think we're there yet. I think gold has more upside, and this is the good thing I see is silver, which typically leads gold, or at least corresponds to it very closely. It has been lagging gold in the last couple of months, and only just now is it starting to catch up. I think that's another positive indicator going forward, for the metal sector.
Is part of that due to, I know some of the big buying in gold this year has been buying by China specifically, like institutional scale buying. Is maybe some of that disparate performance attributable to really targeted buying by some big heavy hitters that are out there? So, China accumulating gold, but not doing so with silver.
Probably central bank buying has been one of the dominant forces in the last couple of years, with China at the lead. But China's central bank evidently has been slowing their purchasing lately. So I would say at this point, it isn't so much China that's pushing the market higher. I think it's frankly hedge funds, institutional buyers, people that are just looking to hedge against what they see as, a potentially weakening economy, weakening global economy. Who knows? Maybe they're seeing a weakening equity market ahead. There's, geopolitical concerns. There's a lot of worries, and I think the bigger buyers, institutionally, are just waking up and saying we need to have some insurance. And I don't see at this point that China or the central banks are driving gold, but the interest is there.
Yeah, speaking of central banks, as we know, the Fed, we're on the doorstep, almost certainly, of the doorstep of the Fed finally starting to cut rates next week. Um, do you think? I mean, do you think this? It's been sort of anticipated for a while now, but do you think the actual process of cutting rates, now that it'll actually become a reality, will be the thing that could lead this rally into the next phase, where it does spread out to be more inclusive beyond, some of the 15 stocks that have sort of carried it for the last year and a half or whatever?
I think so. A lot of people will make the case that the rate the presumptive rate cuts have been baked into the prices. But I don't think that's true, because look how many times the Fed has disappointed the market. There seems to be still some uncertainty among some investors anyway. Are they really going to go through with it this time? I think when they finally pull the trigger and start cutting rates, yeah, you're going to see, this. I don't think this will be a case of sell the news. I think there's going to be a flurry of bullish activity categorically.
Yeah, no, I agree. And do you think the speed at which they cut, how much do you think that matters? Brad and I have been on record. We think we've been similar to what you just mentioned. We've been more Fed skeptics, and we're like, people seem to think they might cut 100 basis points for the end of the year. We were leaning more towards like 50, like two cuts of 25 each. What do you think?
I'll be honest, I don't have a clue, because this Fed
Correct
is
answer.
Yeah,
is
smart man.
thank you. It's
Yeah.
it's unpredictable.
Yeah.
You know that. These guys are not the most transparent, and who knows? But I do suspect that it will be a persistent series of, just a guess, maybe a somewhat persistent series of smaller cuts. I don't think they're going to go overboard
Yeah,
in the first
I
cut or
agree.
two.
I think you're on the same page as us. I mean, do you think the speed matters much, barring them, like, cutting twice and then just stopping, or not cutting at all? Do you think, like, the slow and steady drip like you're describing, do you think, I don't think that'll matter that much. Do you think?
Probably not. As
Yeah.
long as investors see that the Fed is moving in what they regard as the right direction, I think they'll be satisfied.
Yeah.
They've held over. I hate to say this, use this term, but they've held the market's feet over the fire for long enough. And when they start actually cutting, I think people are going to be elated, and they'll take what they can get.
Yeah, it was the first time in what, 3.5 years. I think it's Mike Santolo keeps referring that Fed will turn from foe to friend, to the market. So seeing it is still going to be different from thinking it's going to happen.
Exactly. I think it's going to actually galvanize the market. Just a guess, but I'm guessing there's going to be, so it'll serve as a catalyst. People will be happy. Oh, they finally did it.
Right. Right.
So would you think that some of the, I mean, we've talked for a long time about like record levels of cash on the sidelines. Are you thinking more floodgate, that it's the all clear to get invested, or are you thinking more like, hey, as you know, because rates are competitive at 5% on short-term rates, that's nearly market returns, and it's entirely liquid and risk-free. Um, you know, I'm the sort of official bull, or the official bear of the podcast. So,
Yes.
my thinking is maybe it's more of a slow burn. But what are your thoughts on how cash sort of matriculates out of the back pocket and into the market?
I think initially, I don't want to use the term flood tide, because
Yeah,
that's too risky to
loaded.
say.
Yeah,
I think initially there'll be a flurry, a burst of money flowing back into the market. I don't think it's just going to come whooshing in like a tsunami, but it probably will be, because people are still, they remember the pain of a couple of years ago,
Right.
and I think there's still a fair amount of conservatism among retail investors, and I think it'll be more steady.
Yeah, there's a reason as Brad and I have talked about, there's a reason there's a record, what, $6.3 trillion in money market funds just sitting on the sidelines. That's been going nowhere but up since 2021. So there's money waiting to be deployed, and clearly it hasn't been deployed, even though the bull market is almost 2 years old.
Yeah, and that's another factor. We've seen this happen in the past, when typical investors are sitting on cash and they're watching the market go up, up, up without them. When the time comes for them to pull the trigger, when they get that catalyst, whether it's rate cuts or whatever, they're going to have an incentive to, let's start plowing some cash in to some extent, because we've missed out so much. So I don't doubt it at all that there will be cash coming in. It's just a question of at what speed, at what velocity will the cash flow in.
Yeah, I'm curious how that breaks down between the real leadership that we've had for the last 18 months, or I guess what, 20 months? No, almost 2 years at this point. Geez. I,
23, yeah.
like yeah, there's just so much. I wonder if some of that contributes to maybe a short-term bump in like the plays that have been working, like the semis, like the Mag 7 stocks, and if maybe that's where you first start seeing that new capital dry up when if those sort of top out again.
It could be. There undoubtedly will be the tendency to chase the leaders. I think you can always expect that with I hate to say it, general public, when they get in, they'll chase the leaders initially, but there are value oriented investors in the retail crowd, and they'll be looking, I think, for bargains. So I see it as being across the board. I don't think it's just they're going to be exclusively chasing the big seven stocks. I think it'll be sector wide across several industry groups, pretty well dispersed.
Last question. I talking about sort of your both your loss limits and sort of what I know you don't necessarily have price targets, or maybe you do. I can't remember.
There
But
are, yeah.
there are price targets. Okay. Do you have like, I think your loss limit is in like what, the 14-15% range. You don't want to go, you don't want a stock to fall beyond. Do you have a certain percentage generally that you're looking for, one of your turnaround stocks to rise to, or is it all on a stock by stock basis?
It's a stock by stock basis. I'm not a big fan of price targets, to be brutally honest. I never
Yeah, I
was.
didn't think you were. Yeah.
No, I believe in direction. I think once you get the direction right, you ride it and you take incremental profits. You don't want to be too conservative, and just because it goes up, you start taking your profit. You give it some leeway to go up. You raise your stops along the way, of course, to lock in those profits. But as far as, yeah, I think this stock's going to 100 and it's at 50. There's too many variables. I mean, how can anybody predict that? I do try my best to make these predictions. I do put price targets on all of my recommendations because it's expected of me, but they will be adjusted if I see any. If there's something that changes, I'll change the target. I'll bring it down if I have to.
Yeah, I'm nodding because 100%. Yeah, I took over shortly before you took over Turnaround Letter. I took over the other value investment newsletter we have, Cabot Value Investor, where I set price targets because that's expected of me, and that's what all my predecessors did. But I don't love them. And same thing, like I have one or two. Sometimes it'll hit the target and be like, yeah, it seems pretty highly valued at this point. But the others, like, I don't know. I think this thing is still going higher, and I'll move the goalposts, which sounds like similar to your philosophy.
Exactly. If the times where my stocks have hit the price target, I typically will say, well, let's take 50% profit and
Right.
we'll see what happens after that.
Yeah. Brad, do you have anything else for Cliff?
No, I think I don't know. I'm very curious to see, like, one thing that you just said, with there being value oriented investors out there. I'm very curious to see if this might finally be the thing that finally be the catalyst that does it. Rates finally going down. I do wonder, I don't know, but I do wonder if this isn't a time for outperformance by value stocks. Growth is still flying high. We're still very close to all-time highs on the major indexes. The Mag 7 have gotten all the headlines for the last 2 years. There's a lot of cash on the sidelines waited to be deployed. And if you've got people that are value conscious out there, it's like this might, I mean, you hate to call it, but this might finally be the time where the value oriented investor has an opportunity to outperform. I mean, it's wait and see, but
this is anecdotal, and maybe I shouldn't say this. I don't want to tell tales, but I've noticed even among Cabot analysts, I'm starting to notice a lot of them are recommending what I would regard as somewhat value-oriented turnaround type plays, as opposed to the strict momentum plays. I see it more and more because there's so much opportunity out there, and the smart guys at Cabot, and we have a team of really smart people, and they're saying, hey, why not? Let's go for the value plays. So
yeah. And the value plays far outnumber the momentum plays at this point because haven't been that many momentum plays.
Exactly, and I think eventually the crowd will see that, and I think this will be the time that eventually, in the not too distant future, we'll see value begin to finally, um, if not outperform, perform as we expected.
Right. It's a good hedge. Well, if you can read more from Cliff, I highly recommend subscribing to his Cabot turnaround letter advisory. It's on the cabotwealth.com page under premium advisories. Cliff has an update every Friday and monthly issues. Is that right?
That's correct.
Yeah. Also a podcast as part of that. And also what's called a catalyst report, which lists off, potential catalysts for various stocks in the portfolio. Cliff, thanks for joining us. And I hope, not only hope that you're right about the rates falling being different from rumors of rates falling, but I think you will be. And if you're right, we'll have you back on to take a victory lap a few months from now.
Thanks. I appreciate it, Chris and Brad. It was good being here.
All right. And thanks. And thank you all for joining us on today's episode of Street Check. We'll be back next Friday.